In 1967, Warren Buffett paid $8.6 million to acquire a small, Omaha-based insurance company called National Indemnity. At the time, most of his investors assumed this was a straightforward value play, a modestly profitable business trading below its intrinsic worth. Classic Buffett. They were right about the acquisition, but they were almost completely wrong about the reason. Buffett wasn't buying an insurance company. He was buying float, a mechanism buried inside the insurance industry that transformed an otherwise ordinary business into one of the greatest capital allocation machines ever created. Because Buffett had identified something structural about insurance that most investors weren't paying attention to, a mechanic hiding inside the business model itself. Insurance, run correctly, was not really an insurance business at all. It was an infinitely renewable, interest-free loan from millions of strangers that you could invest however you liked. 50 years later, that $8.6 million acquisition has compounded into an insurance operation generating more than $160 billion in investable capital at any given moment. Berkshire Hathaway is now one of the largest financial entities on Earth, and the engine underneath all of it is a concept so simple it fits inside a single sentence. The mechanism was sitting in plain sight. Most investors simply weren't looking at the right part of the business. When most people think about insurance companies, they think about a business that takes in premiums and pays out claims. The profit is the difference between the two. Simple enough. But that framing misses the most important part of the model entirely. There is a gap, sometimes months, sometimes years, sometimes decades. With neither. You are not paying the insurance company to hold your money, and they are not paying you interest on it. From a capital allocation perspective, it is the closest thing the financial system produces to free money. Buffett's float at Berkshire grew from roughly $39 million in 1970 to approximately $164 billion by 2023. That capital has been continuously deployed into stocks, bonds, and entire operating businesses for more than 5 decades, generating compounding returns on a capital base that cost almost nothing to maintain. And in many years, the insurance operation itself generated underwriting profits, which means the float did not merely cost zero, it had a negative cost. Berkshire was effectively being paid to hold other people's money. The analogy is almost too perfect. Imagine a bank gave you an ever-growing line of credit, charged no interest, occasionally paid you to keep using it, and only asked that you manage it responsibly. That's float. That's what Buffett bought in 1967 for $8.6 million. Reason 2. The reinsurance layer nobody sees. Above the insurance companies that you and I interact with sits another layer most people never think about: reinsurance. Reinsurance companies insure the insurers. A normal insurer is exposed to one house fire. A reinsurer is exposed to every house fire on Earth. When hurricanes, earthquakes, pandemics, wildfires, or other catastrophic events generate losses beyond what a traditional insurer can absorb, the reinsurer steps in. Munich Re, Swiss Re, Hanover Re. 3 companies with more financial firepower than many sovereign wealth funds. Yet most people have never heard of them. Munich Re alone manages hundreds of billions of euros in investments. Its business model is essentially float at industrial scale. Premiums arrive from thousands of insurers around the world. That capital sits on the balance sheet, gets invested, and in many cases remains there for years before a meaningful payout occurs. The 2011 Tohoku earthquake and tsunami generated approximately $35 billion in insured losses, one of the largest insurance events in modern history. Munich Re absorbed a substantial portion of that exposure, reported a loss for the year, then continued operating normally. Why? Because decades of premium income, continuously invested, had created a capital base large enough to absorb extraordinary shocks. That's the real power of reinsurance. It turns catastrophe into a portfolio. And over long periods of time, that portfolio becomes one of the most resilient financial structures ever created. Reason 3. The ownership nobody maps. This is the part most financial journalism consistently underreports. Insurance companies and their asset management arms are among the largest owners of financial assets in the world. BlackRock manages around $10 trillion. Vanguard manages roughly $8 trillion. But the global insurance industry collectively controls approximately $35 trillion. And unlike index funds that passively track markets, insurers actively decide where much of that capital flows. They are major holders of government bonds across virtually every major economy, which means insurance companies are not merely participants in the economy, they are among its largest creditors. They hold substantial equity positions in public companies. They finance infrastructure projects, toll roads, airports, utilities, renewable energy installations. Because long-duration infrastructure assets align perfectly with long-duration insurance liabilities. When governments need buyers for 30-year bonds, insurance companies frequently provide the capital. When corporations issue debt to fund acquisitions, insurance companies are often among the lenders. The visible financial institutions get most of the attention. The insurers, supplying enormous amounts of the actual capital, do not. It would be easy to frame all of this as a story about one extraordinarily clever investor spotting something obvious that everyone else missed. And there is some truth to that. But the more important lesson is structural. The float model is not a loophole. It is not a trick. It is not an accident. It is a direct consequence of how insurance works. The reason more people did not exploit it earlier is surprisingly simple. Insurance is boring. It lacks the excitement of technology, the political drama of banking, the cultural fascination of consumer brands. It sits quietly in the background, collecting premiums, paying claims, compounding capital, year after year, decade after decade. Buffett's real insight was not financial genius. It was the willingness to look carefully at something everyone else had decided was too boring to examine. That turns out to be a remarkably effective investment strategy. Most people think insurance companies sell protection, and they do. But that isn't the real business. The policy is the product customers see. The float is the asset owners buy. Buffett understood that in 1967. 50 years later, that insight helped create one of the largest pools of capital in financial history. Because insurance companies don't just transfer risk, they convert time into investable capital. And at global scale, that capital quietly finances a surprising amount of the modern world. They are boring by design. And that, as it turns out, is exactly the point.